Hey, Courtney Carroll here from Fit Money IQ. What if what you do with a dollar was the key to your financial success or your financial failure? What if there was a simple formula that, if used, can unlock true financial wealth? Would you take a listen? Well, today you're in luck because today we're going to share with you what to do with a dollar, where to put your money, where not to invest, and most importantly, showing you the math behind the numbers for what would happen if you invested $200, $300, or $400 for 20, 30, or 40 years. Before we unwrap today's video, I want you to like, subscribe, and share this with your friends and family members if you find value in what is here. Now, let's jump into this. About 20 years ago, I had the privilege of teaching a financial literacy class to 8th graders. One of the questions I asked at the time was, what would you do with a dollar? And not surprisingly, 8th graders as they are said, I would simply go to the store and I would purchase something with it. Typical answer one would expect from an 8th grader. Well, let's fast forward 20 years later to about a week ago. I had the same conversations with a group of college students. Same answer. It is only a dollar. I would wait to have more money and then I would buy something with it. Wow, 20 years has passed and the same philosophy on money still exists. Most individuals think only of spending rather than investing or saving. But what if there was a better option than just spending that dollar? What if how you managed $1 had the key to unlocking your financial superpower? What you do with a dollar is based on your personal philosophy about money and how you were raised. In society, we have two groups of people. The first group believe that it's their money. They've worked hard for it and they should have a right to spend it as they see fit, even if it means spending all of it. Now, the second group believes that a part of all they earn is theirs to keep. They are committed to saving and investing for their future selves, and they make this a habit prior to giving any obligations to expenses such as bills, rent, and so forth. It is the same dollar, but markedly two different philosophies that govern how people respond to the dollar. One philosophy, if left unchanged, spending all you earn will lead to financial disaster. The other philosophy, paying yourself first and investing for your future, has the power to lead to financial success. How? It's only a dollar, right? True. But let me show you how. The strategy is simple but extremely sound. I want you to take a look at this chart. It's the chart on balancing your financial life with the 60-20-20 rule. Now, 60% of your after-tax money should be devoted to your living expenses. It used to be 50 at one time, but based on inflationary pressures, wages not keeping up with inflation, 60% seems more reasonable, especially if you live in an expensive city like Toronto. So that is for your needs. These are things that you must pay. These are obligations that you must pay, such as your housing, your utilities, gas, groceries, and food and so forth. 20% should be towards the things you love, the things that create lasting memories, that are fun to do. Maybe you've got a hobby that is sports, you like to go to entertainment, you like to go to concerts. Maybe you love traveling. You've put money away in your travel fund so you can go and explore different countries around the world. You need to live life, and so you can have your cake and eat it too, just not all at the same time. So you need to make sure only 20% of your income goes towards your wants. The other 20% is going towards your savings and your investing. Now, it's important to distinguish between what savings is and what investing is. Savings, putting your money in a bank, getting less than 0.5% is not what you want to do with your money. You can do that for short-term things such as emergencies, but you want to put your money to work in appropriate instruments that will compound your money over time. So that 60-20-20 rule, if followed, I know for some this will be difficult, but it is the key to unlocking your financial superpower. Investing 20% into your future self is the disciplined habit for creating a successful financial life. And I know what some of you are saying. I don't have 20%. That's understandable. You don't have to start with 20. You can start with 1, 2, or 3% and build upon that. The key is the consistency of doing something over and over and over in your life. This consistency and habit forms your philosophy about money, and it will be there for you when the income changes and you move from $1 to $100 to $1,000, $10,000, $100,000. If your plan is to create a strong financial house, you cannot follow the masses and spend everything you earn. This video is a warning to walk away from the majority and create a new path towards your financial success. What you want to do is to invest at least 20% of your income into your future self. You want your money to be fit so it can sustain you throughout your retirement years. So the question then is, where do you put your money? The key to building wealth is to invest early and on a regular basis, what we call the reps. Invest and reinvest the profits, which are the returns from your investments, and stay disciplined in the market for as long as you possibly can, 30, 40 years. There are no shortcuts to building wealth, just like there is no shortcuts to your physical fitness and your mental health. Like your fitness goals, your daily grind in the gym, putting in the reps on a consistent basis is what leads to improvements, the results in your physical fitness, your ability to lift things, your cardiovascular efficiency, your flexibility, and your ability to do this consistently throughout life is the disciplined habit that will lead to strength, vitality during your retirement years. So approach your investments like you do your fitness goals. This way you will retire with strong financial foundation and your health and vitality intact so you can enjoy your life and your money. I want to share 3 keys for successful investing. Number 1, your investments should be boring, predictable, safe, and provide an average return over the life of the investment. It's easy to get misled by marketing schemes, advertisement that you see about the complexities of investing and the importance of buying the next hot stock. Buying and looking for the next Google, Nvidia, Apple, Microsoft, or the next Bitcoin is gambling because you can never predict which company is going to take off. Instead, my approach and my suggestion is that you look for boring, safe, predictable, and time in the market with your money so it can do what it needs to do with the magic of compounding. You will find that most people who've created wealth in their lives, this is a strategy that they have done. Number 2, I want you to do this. Avoid professional money managers when it comes to your investments. Money managers are a dime a dozen, and I say that respectfully. The average money manager underperforms the market 8 out of 10 times. So if 80% of money managers are underperforming the market, why are we paying them fees to manage our funds? I do not like those odds, nor should you. Instead, I'm suggesting that you invest in index funds. Index funds basically are the following. I want you to take a look at what's on the chart. What it is, an index fund is an investment vehicle that is designed to track a certain benchmark index. An actively managed fund claims to beat the index, while an index fund simply aims to match the index. This again falls in alignment with what I just said. You want it to be boring, you want it to be predictable, you want it to be safe, and you want it to be average. Investing in passive instruments such as S&P 500 or TSX, as well as other indices, have consistently shown average returns of about 10.5 to 11% over the last 30 years. In fact, take a look at this chart. You will see that the average returns of the S&P 500 since 1990 to 2023 returned 10 to 11% over that time frame. That includes dividend reinvestments. You do need to keep in mind, though, as an investor, that variations do occur in the market. Markets' results from one year to the next can vary significantly from the average. Buy and hold investors, what we're looking at is long-term staying power in the market. You're not looking to jump in and jump out. Buy and hold investors are far more likely to earn best returns over longer periods of time. So the longer your money stays in the market, the better the probability of you having these average returns. Thirdly, I want you to avoid MERs. High MERs. MERs is management expense ratios. These are the fees charged for managing your portfolio. As I mentioned, I'm a strong advocate for you doing it yourself and buying the index rather than going to a actively managed portfolio. Expense ratios paid to managers can range anywhere from 1% to 2%. They may not seem like a lot, but that is 1 to 2% of your total portfolio value at the end of the year. I recommend a passively traded fund like the index or ETFs. You can have Vanguard or Fidelity funds that are 0%. That's 0% fees for buying those indices. But the average range is anywhere between 0.03% to 0.15 or maybe 0.2%. Paying higher for passively managed indices, probably not in your best interest, so look for those that are low fees. Fees matter. I want you to take a look at this chart. If you had invested $10,000 for 40 years at a 10% average return, this is what would happen. On the left side, you would see that your investment portfolio would have grown to almost $450,000. It's actually $446,000. And you'll also see that there's a small fee that you would have to pay for having this index bought. The management expense ratio for buying this index is 0.04%. On the flip side of that, maybe you had this managed by a portfolio manager and the same amount of money, $446,000, because you were paying 2% in fees annually against the size of your portfolio, would have robbed you of significant gains that your funds would have made in the market. In fact, look at what you're taking home. Your final investment value would be $217,245. Now I ask you, is it fair for you to give up half of your portfolio value to someone who is managing your investments and underperform the market 80% of the time? I'll leave that question with you because I'm pretty sure I know what the answer is. You're probably still not convinced. Well, let me share this with you. It's been 20 years since I had the pleasure of teaching that 8th grade class about financial literacy. 20 years is a long time. So what would happen had they invested 20 years ago $200, $300, or $400 in an index like I'm sharing with you today? What would their portfolio be worth today? And what would those fees be if they were having it managed by a professional portfolio manager? Well, let's take a look. I want you to take a look at this chart right here. $200 invested each month for 20 years is a total out-of-pocket investment of $48,000, but your final portfolio after 20 years would be $103,000. An additional 10 years would bring that portfolio to $242,000. That's $250,000 by investing $200 per month for 30 years. If you skip down to $400 a month, in 20 years of investing $400 a month, your out-of-pocket investment is $96,000, and you would have had $207,000 total accumulated in your investment account. If you did 30 years at the same $400 a month, that would have ballooned to $485,000. Between the 20th year and the 30th year, your money more than doubles. This is the magnificent power of compounding, what Albert Einstein called the 8th wonder of the world. Your money doubles in that 10-year frame, and that is a snowball effect that most people do not understand and do not spend enough time thinking about until it's too late. Just like your profits compound over time, the fees you pay to portfolio managers also compound the longer your money is invested. And I want you to take a look at what happens at $200 a month for 20 years. You're paying $11,000 of your portfolio balance to your fund manager. In 30 years, that is $41,000. Notice that in this situation, your money is going up as far as fees paid out almost 400%. I want you to flip down to the bottom slide where it says $400 a month. After 20 years, you're paying out $22,312 to have someone manage your account, charging you 1% fee. An additional 10 years, that will be $81,600 from your portfolio. Are you willing to pay that amount to professional money managers who underperform the market 80% of the time? I'm not sure if you would. I wouldn't do it. So this is why I'm a big proponent, advocate of buying the index and minimizing your expense ratios. So listen, I have made countless errors in my financial judgment over the years, errors that have set me back financially, but I've taken corrective steps to position me well for my retirement. And I'm sharing my past with you to make sure that you don't follow the same mistakes in judgment and that you understand what is here in front of you. It doesn't matter how much runway you've got before retirement or how many years you have in retirement. The key is to start. If you find value in what I'm sharing here today, I'm going to remind you to like, subscribe, and share this video to your networks, to your friends, so this channel can grow. Throughout the years, I've attended many seminars, read many books on finance, and one of the things I understand is that success leaves clues. It is the simple disciplines practiced every day, such as paying yourself first, that will put you on solid financial ground. Failure are errors in our own judgment repeated on a daily basis over and over and over that will lead to financial disaster. When it comes to investing, you don't have to be great to start. You just have to start to be great. It doesn't matter where you are. The key is to get started. So, what will you do with your dollar? There are two options. Which philosophy governs how you manage your money? I want to hear from you. In the comment box below, please indicate what you do with your money. How do you spend it? Are you 50, 30, 20? Are you 60, 25, 15? I'd love to hear from you. Leave a comment. Let me know if this video resonates with you. We'll look forward to having a conversation on the next one. Courtney C., Fit Money IQ.